Welcome to another episode of A Quest for Twice. Today is July 27th. I'm going to provide a market overview first, then provide an earning update from Equifax. So this year, the market has been pretty bad in terms of returns. S&P 500 declined for about 18% year to date. So what's driving the declines? The answer can be found in the PE ratios of the S&P 500. I plotted in this graph. That's a price to forward earning ratios of S&P 500. We can see that in this year, there has been a dramatic decline for about almost 30% PE reduction. That's actually more than the market return because the forward earning has actually been revised up. So the valuation decline single-handedly explains the market decline. Now the PE ratio is about 16, and that is a historical average. So the market may be getting cheaper. So will the market stop decline and start to climb again? Key question now is will earning estimate hold up? If the forward earning is reduced, even if the PE ratio stays the same, the market will decline with the reduced earning. That's why it is so important to keep track of the earning reports in this earning season and the management outlook given for the rest of the year. So in this week, Equifax provided the earning update. The key changes are highlighted in red. So the mortgage headwind intensified in 2022 and become stronger compared to the earning update given in April. Now the management forecasts 37% fewer mortgage increase in 2022. Because of that, now the management forecasts the 2022 sales will be about 5.1 billion instead of 5.3 billion initially given at the beginning of this year. That represents 4% growth year on year. As shown in the figure at the bottom right, the green bars are the core business performance, and the purple ones are the mortgage-related business performance. In the second quarter, the core business grew by 19%, but the mortgage business declined by about 10%. So the overall business growth was 7%. Management forecasts 17% core growth in the Q3 of this year, but the mortgage headwind will intensify with a 15% revenue reduction. So the Q3 revenue will be roughly flat year on year, and the whole year the growth will be 4%, as I mentioned earlier, with the core business grow by about 17%. So the bad news is obviously the stronger mortgage market decline. The good news is the core business stays solid and still growing very fast. That growth is driven by workforce solution. Another highlight is to note that despite the margin impact from mortgage market contraction, gross margin and EBITDA margin will actually increase slightly compared to last year. That shows the strength of the workforce solution and other core business. So what are behind the growth of the core business? As I mentioned before, the growth is driven by cloud as well as new products and innovations rollout. So as shown in the top right, year to date, there has been about 50 new products rolled out, with a vitality index reaching 13.1 in second quarter, compared to 10% long-term goal. So the whole year, forecast is 11% vitality. That shows the strength in the new products and the innovations. And the workforce solutions are still growing very fast. If we exclude the mortgage market, which is cyclic, the core workforce solution is growing about 41 to 45% in the first half of this year. Lastly, Equifax is still doing mergers and acquisitions, with the recent announcement of acquisition of Logics in Q3 2022. So all those drivers should continue to drive future business growth. So let me revisit my original investment thesis. At about $198 per share, Equifax enterprise value is about $30 billion. I estimate its 2022 EBITDA will be about 1.65 billion and gives the EV over EBITDA ratio of 18. And future EBITDA growth should be greater than 12% annually once the mortgage headwind dissipates. Even without the tailwind, the growth should be evident without the headwind from mortgage market. So its moat still intact, and one is wide and growing with more and more data and more acquisitions. Year to date, it has spent more than $124 million on mergers and acquisitions. And that, in addition, adding to future margin expansion, it's also adding its mode. So I believe the original thesis is still intact. That is to buy a high-quality growth company at a reasonable price. The original threats and the opportunities are still valid, with a small update related to the mortgage market. Now with the contraction, the mortgage market revenue will likely be about 23% of its 2022 revenue. And if we look at the potential refinance candidates, we see that it had a big drop from January of this year to April. In January, there were about 16.2 million of potential candidates. In April, that number declined to about 3.3 million because of the significant increase in mortgage rate. Now that number stands at about 1.9 million because of further mortgage rate increase. However, because of that larger reduction in number of candidates, there is very little room for further reduction given how small the base is. That's why I believe its business will stabilize, given that the mortgage market revenue is only less than a quarter of its total revenue. We should see that bottom out in the second half of this year. And even with that holding steady in the next several years, its growth strength in its core business will drive its growth. This concludes the latest episode of Quest for Twice. Until next time, happy investing.